My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends, just trying to make you some money. My job is not just to entertain you, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Look, there's systemic risk, and then there's market risk. These are two very different things. Systemic risk is just plain old bad news that you cannot profit from, even if you're bullish. And when you're facing systemic risk, there's very little reason to buy anything. You just have to take your lumps or get out of Dodge if you can't handle the pain.
The house of pain.
But market risk? Market risk, the opposite. It's a godsend if you know what you like, because it can create miraculous buying opportunities on the way down. You may find it odd for me to hit a bull button on what is really market risk, but that's what we wait for here in Cramerica. See, after a day that started strong and then waned, with the Dow dipping 51 points, S&P dropping 0.08%, and then NASDAQ climbing 0.22%, we need to figure out what about this moment is market risk and what's systemic risk, so you can do this at home. Now, we know we have several market risks, right? I mean, we have the Fed tomorrow. I mean, who knows what's going to happen there? Who knows what's going to happen with this debt ceiling fracas? It's feeling a lot like the one that put us through the meat grinder 10 years ago, before the whole thing was resolved. But then there's China, and this is where I differ from most of the people you hear. This is widely regarded as a systemic risk that you can't be bullish about, something that could create a contagion that reverberates throughout the whole world. China's second largest real estate developer is this company called Evergrande. And it is on the verge of collapse because it has $300 billion in obligations that it can't meet. Wall Street's worried that Evergrande will crush the banks that lent it money, and from there the pain will spread throughout the global financial system. Now, countless commentators have described this situation as the Chinese Lehman Brothers, which means it can take down almost everything. And I say, even though I expect it to fail, that's not the case. I also believe that the contagion will be kept within China's borders. Remember, the PRC has a command economy in free market clothing. When they have an enterprise that's too big to fail, well, the Communist Party can determine how bad things really will be. They have the power to decide who will feel the pain and who will come out unscathed. Right now, it's looking like their government would rather let some of the worst scofflaws get away with the financial equivalent of murder than allow this whole edifice to collapse. And President Xi has made a mistake here. But it's not the end of the world. See, in the end, the Evergrande fiasco is, well, it's bad news for American stocks, but I think it's market risk rather than systemic risk. Again, market risk, systemic risk. And I've got to tell you, despite what virtually everyone else is saying, I think it's an opportunity. But I expect more pain as it shakes out. Just because I think it's an opportunity doesn't mean I'm saying it's an opportunity right now. Now, I'm always telling you to have a shopping list ready for these moments when the whole market looks like it's going to get hammered. At the moment, you should focus on companies that have gone through the COVID mill and come out on the other side. Unfortunately, so many of the older companies that have seen their stocks roar, even as their businesses might be slowing here, they got too much exposure to China, and China is going to have a slowdown because of Evergrande. You need something that can thrive even in a weaker economy. Now, some people could say that could be like Adobe, the digital media marketing colossus that just reported what I thought was an excellent quarter. It was a clear beat and raise with only a bit of hair on it. Yet the stock got hit anyway, which, by the way, has been a consistent pattern before every single run to the upside. Adobe comes down, the decline lasts 2 days, and then you buy it. More on that later. How about the newly minted companies that have come public recently? Well, we've had so many IPOs in the last year that it's impossible to keep track of them all. I try. I got lists and lists. I got lists of SPAC deals, too. Almost every one of them is a loser. The insiders in these stocks, the new guys, are bailing out left and right. I don't have any of them to say that. I don't know, maybe Upstart. I like Upstart. But most of these things I really can't stand. But then there are a handful of newer names that I absolutely love that many people seem to hate. Yet they actually might be ideal for this moment. They all have similar characteristics. They are now seasoned businesses with amazing CEOs that have run the COVID gauntlet and come out on the other side in a positive fashion. I'm going to start with one we've been talking about a lot lately, and it's Airbnb. The company was on fire going into the pandemic. Then it hit a wall, the likes of which few businesses have ever bounced back from. They went from gigantic revenues to almost none. So did CEO Brian Chesky give up and fold up shop? No. He did make big layoffs. But he stayed in the game long enough to realize that renting a house from an Airbnb host was often cheaper, more convenient, and safer than staying at a hotel. Turns out Airbnb is the best way to take a vacation in the midst of a pandemic. No crowded elevators, no service, no restaurants. All that stuff's closed anyway. Now, Airbnb just announced on our show last night that it just logged its billionth customer. And it keeps improving its platform, making major improvements in its app endlessly. When my daughter, who taught English in Madrid, got stuck in lockdown in that city for her entire stay, Airbnb let her visit a different part of town and stay in a nicer house each weekend. Now, these guys, Airbnb, are basically the only game in town. They pretty much have this whole market to themselves. Then there's Uber. Now, this was merely a ride-sharing company when it got started, but then it got into the delivery business with Uber Eats. The company consolidated the industry, then doubled down on delivery, acquiring an outfit called Drizzly that delivers liquor straight to your door. That Drizzly deal has opened up many new markets for them that most of us never even thought existed. It's a two-way street now with Uber. That's how they're now able to raise guidance significantly, and why you see underneath me the stock continuing to climb, and it'll probably have a slew of recommendations and upgrades tomorrow. When CEO Dara Khosrowshahi came on Squawk Box this morning, excellent interview with Andrew Ross Sorkin, he talked about how profitability is finally here. I cheered because this is a great company. Next, how about DoorDash? This is another delivery service. The rap on DoorDash was that it would be great as long as the pandemic lasted, but once we beat COVID, people would start going out again, making the platform a lot less essential, if not needed at all. Of course, the pandemic stuck around for a long time, but even when the COVID situation was looking better a few months ago, DoorDash never went away. Turns out people like getting online delivery, whether it's food or liquor. Yep, DoorDash does that too. And by the way, what they like is they get the food, but they don't have to pay for the liquor, which is always higher price. Just as important, when things get tough for the restaurant industry last year, DoorDash's CEO, Tony Xu, didn't say, sorry, we got to make our quarter, pay up. Instead, he offered a tiered system, giving breaks to struggling restaurants. In the meantime, DoorDash helped consolidate the industry, went big in the suburbs, not just the cities. Not long ago, it was a very crowded space, but now it's a two-man game between Uber and DoorDash Grubhub on the periphery. Hey, speaking of someone with a couple of restaurants, I don't know what we do without Xu and his company. He made himself indispensable. Now, you could argue that all these gig economy businesses could be regulated out of existence if the government ever gets involved. We know California is already making life difficult for the Ubers and DoorDashes of the world, forcing them to give their drivers the same benefits they'd extend to regular employees. The thing is, these are all incredibly popular. That's why I'm highlighting them. They're amazingly popular services. So I doubt the state or the federal government will regulate them into oblivion. Who wants to run for office as the guy who killed Uber or Airbnb or DoorDash? It's just not what you want to do. Here's the bottom line. I like the services that are Airbnb and Uber and DoorDash because these companies didn't just sit there and take a beating. They got up off the floor at their darkest hour and reinvented themselves. The pessimists, for instance, like Goldman Sachs, which started coverage on Airbnb last week with a sell rating, they just don't get it. You either go with Brian or go with Tony or you go with Dara or you just go home. These aren't pre-pandemic stocks and they aren't post-pandemic stocks. They are great companies with dexterous leaders that you should not be afraid to buy into in what many think is a perilous systemic risk moment, even as I don't see it that way.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.